Hi, this is John Pugliano. I'm coming to you from another road trip. Today, I'm on a very noisy and windy and cold street corner in Colorado, and I'm making this video because I wanted to make a point about where I think the economy is headed in 2023, and I wanted you to see this sign behind me. Let me go someplace warmer and we'll talk about it. Okay, so it's a little quieter here in the car and certainly a lot warmer than it is outside. I just want to give you an update. You know, I've been traveling extensively this year. A lot of my trips have been road trips where I'm actually driving. I've crisscrossed the country several times, and I've made a couple videos as I've traveled, and I've tried to make the case that the economy was actually very solid this year. I know a lot of people were worried about recession, and we've seen the stock market go through some real gyrations, and my predictions on that have definitely been cloudy. But in terms of the overall economy, the problem has not been this year. That's the point I've been trying to make, and I think the problem will come next year, most likely early in 2023. And I want to talk about a couple of those reasons now. The main point of this video was to show you that sign, because that's going to emphasize one of the key points to why I think we go into a problem next year. And in addition to the few things I talk about now, there are a whole lot of other geopolitical issues which could cause something to break in the economy. And if you look at, past incidents when we did have a major pullback in the economy, where we had a stock market crash like the dot-com bubble or the housing crisis of 2008, those events occurred not just because the economy went into a recession, but because also there was another black swan event that caused things to get worse. In the case of the housing crisis, it was the Lehman Brothers bankruptcy, and that's when the stock market really took a major fall. And in the case of the dot-com bubble, people forget this, but the market didn't go on to put in a very severe low until well after the bubble burst in the dot-com companies. It was actually the terrorist attacks of September 11th that really caused the market to go into a tailspin and to be into a major stock market crisis for several years, well beyond that dot-com bubble. So it's very likely that next year we could go into just a garden variety recession. That would be a soft landing from the Federal Reserve. They could possibly orchestrate that. Even if they do, I think that we put in lows that are lower than what we saw this year. And then also, if something breaks, if a black swan event occurs, if it's something either geopolitically or within the financial system, then that would make the lows that we saw this year, insignificant. We could go down another 30 or more % from the lows that we saw in September. Now, I'm not predicting that because I don't have, I was going to say I don't have a crystal ball. I actually do have a crystal ball. Someone gave me one because I always say I don't, but you know what? That crystal ball doesn't work. I can't predict the future. So I don't know if we're going to get a black swan event, but I can look at the clouds on the horizon and I can see a number of problems happening. And in particular, whether we get a black swan event or not, there are 2 or 3 things that are top of line as to what could cause a major market pullback earlier in this year, and that's the U.S. going into a recession, whether it's a garden variety recession or not. And the key thing to remember is that as far back as I've looked in history, I can't find an event where the stock market bottomed before the country went into a recession. So once the economy goes into a recession, the market may recover from that, but it usually, as far as I can tell, as far as I can look in the charts, it has always bottomed into the recession, not before the recession. And we have not yet gone into a full-blown recession. GDP is going to grow this year. Corporate profits, although they're not growing at the the double-digit amount that Wall Street first forecasted, we're still going to see a 3 or 4% growth in corporate profits in 2022. So we are not yet in a recession. The worst is not yet behind us. So that means, from a historical perspective and a probability perspective, that the market still has farther to drop to put in a low as we go into this 2023 recession. Now, you saw that sign where I showed that this restaurant is offering $30 or more an hour for wait staff, And even with that, the restaurant is closed certain hours of the day because they still can't get enough people to work. Now, that's an overhang of the pandemic. It's one of the problems with too much money that's been printed and all the government largesse. But the bottom line is it's still occurring. It hasn't gone away. And there are, it depends how you estimate it, but well over $3 trillion of what the Federal Reserve calls excess savings. That's one of the reasons that people aren't yet back at work. If you listen to my podcast, you know that I've also talked about things like this great transfer, intergenerational transfer of wealth that took place during the pandemic when, that million people that died, many of them were senior citizens, and that money that they left was inherited by their children and grandchildren. That has not yet dissipated its way through the system. So in addition to all the money that the government printed, there was also these other areas of income that people received where they haven't spent it all yet. In spite of that, we are still seeing some of the greatest amounts of consumer debt taken on in the last 20 years. So that money is dwindling, but it's still out there in the system. And even though the Federal Reserve has raised interest rates from nearly 0 to now 4%, we still are in an environment where employers cannot pay enough to get people to work. That's a sticky situation, and I think that where the Federal Reserve may fail in raising interest rates is that they're going to have to either take them up higher or keep them higher for longer in order to create the unemployment that they're trying to get the labor costs down. And make no mistake about it, the Federal Reserve has two mandates. One is price stability. The other is maintaining maximum employment. Right now, they're thinking that maximum employment needs to put at least 2.5 million workers on the unemployment roll. And they may either purposely or inadvertently end up causing more than that to get unemployed, and that's where we could get into a very deep black swan event. I don't know that that'll happen. They may pull off a soft landing, but we want to watch that. We want to watch the unemployment rate. The other couple things to consider are related to that, and that has to do with the things I've talked about before about the Federal Reserve. Although they can raise interest rates to try and quench demand, they can't do anything about supply. So they can raise interest rates all they want. They're not going to pump any more oil, or they're not going to grow any more food. So the big problems, the big choke points that are creating global problems are energy production and food production. And our Federal Reserve or the other global central banks, they can't do anything to help that supply side. So again, that's where I think we continue to see stickiness in inflation and where a black swan event can occur. One final point I want to edit in here and I want to finish up on, and that's corporate profits. Right now, Wall Street analysts are still anticipating a high rate of return for corporate profits in 2023. Now, unless the Federal Reserve can orchestrate the softest of soft landings, I don't see how that's possible. So what we want to watch for as we get into the end of 2022 and the beginning of 2023 is for the analysts to bring down their profit expectations for the following year, for into 2023 and into 2024. And so what that could do is give a double whammy to the stock market. And this is what we saw in 2008, when you not only had the profits coming down, but then also forward profit expectations coming down, and you combine that with an overall souring of the investor and their amount that they're willing to pay for their price to earnings ratios, then the valuations contract as the profits are coming down. And that's how you see the market drop an additional 25, 30 or more percent. So keep your eye on corporate profits. From a long-term perspective, that's all that matters anyways. And I think right now we're going into 2023 and 2024 with corporate profits being much higher than they could likely get if we see the demand destruction that the Federal Reserve is trying to create by raising interest rates, well in excess of 4%. Well, hey, that's all I have for now. Until next time, this is John Pugliano wishing you the very best returns.